What the F is going on? Jobless claims came in at the lowest level we've seen during the entire pandemic last week. 10-year treasuries are pretty stable around a 1.6. Inflation-protected securities, or treasuries, called TIPS, which usually give some indications of big inflation expectations, aren't really pricing in big inflation expectations. It's almost kind of like the bond market is starting to listen to Jerome Powell when he goes, "We ain't raising rates anytime soon." And all of a sudden we get this flood of really good economic data. In fact, the United States might be on course to grow faster and end up being bigger than had we not had the pandemic, which is crazy because if you think about it, like we think, oh, we're on this course of growth as a country. Oh, COVID comes, we dip, and then we V back up to where we were. We are on track to actually Ving back above that trajectory we were on before, thanks to all the stimulus. At least that's what the IMF and the World Bank see, according to the Financial Times. Folks, all the news coming in right now is pretty much good, like really, really good. Yet you look at stocks and you're like, yeah, I ain't seeing it in certain sectors. Tech, high multiple, SPACs, man. Woo! Not seeing the happiness, not seeing the goodness, which is really kind of a weird twist because don't you remember last year when we had those memes of the child on the swing, and the child on the swing was the stock market, and the big fire in the background, the building on fire, was the economy? It's almost kind of like in some sectors of the stock market, that's reversed right now. It's like the fire is high multiple stock or any high multiple stock, and the kid on the swing is the economy. Because things overall, data-wise, look like they're booming. Housing's booming to the point people believe we're in a massive bubble. Index funds like the S&P 500 and the Dow are overall booming. Bonds aren't doing terribly. Again, economic data is coming in crazy to the point where we're going to be larger than where we were before the pandemic and growing at a faster rate thanks to all the stimulus. And we still got a ton of frickin' pain in different parts of this market, and it really sucks. And the question is, why? Why is it happening? Well, we have a new reason today, and we're going to combine it with some of the other reasons, and this hopefully gives us a clear picture of what's actually going on. Have we just made stupid decisions? Are we idiots for having bought the stocks we did, and then now we're heavy bag holders and my arms are getting tired because I reference how my stocks are upside down every day? Sorry, that's a reference to like the comments, because in the comments it seems like everybody lately has been talking about how many bags they're holding, and it's really bad for your psychology. Just stop looking. But anyway, let's try to understand what's causing this. So first things first, and the first thing here is actually a new piece. Today, we heard an interview that gave us a little bit of extra light, and it's entirely possible that hedge funds are putting the squeeze on some of our favorite high-value names because expectations are so lofty that this economy is going to boom so hard, and that quarter one earnings are going to come in so strong, and that quarter two earnings are going to come in so strong, that hedge funds that might have large positions in companies like maybe, because there is a large institutional ownership in companies like CCIV or companies like Tesla, Apple, Amazon, whatever, maybe some of these companies are starting to sell off a little bit, mostly more like the NEOs, the CCIVs, the SPACs, the Teslas, the energy stocks, the charger stocks, the Enphase, right, the higher multiple ones. The Etsy's, the Pinterest, these. Anyway, why are we starting to see a sell-off in these? Because when you have a higher multiple stock and expectations for that stock are very high, so you've got high earnings expectations and it's already trading at a high multiple. Well, when something's trading at a high multiple, it swings generally more to the downside than it does to the upside. So if those high earnings expectations miss even slightly, we could see a big swing to the downside on higher multiple stocks because they're built up on more of what I call hopium. That's juicing up the stock valuation on some of these. Now, if the companies hit, that's great. We win, the stocks go back up, hopefully well and substantially, that'd be nice. And we go back to kind of the market that we were used to in maybe November, December, January, where we don't just have 2 months of pretty much straight down into the gutter. But the problem is, because these expectations are so high on the high multiple stocks, and they are high multiple stocks, so by virtue, they have more room to go down, hedge funds who are invested in these stocks are realizing it'd probably be prudent to short these stocks as a way to hedge their portfolio. And this totally makes sense. So just as an example, if you have $100 million as a hedge fund in Tesla, you don't want to lose clients when Tesla goes down. Because if you're a hedge fund and you start getting phone calls like, I heard there was a crash with Autopilot in Texas. What is going on? I want to know about what the heck is happening in Texas. You know what? I want my money out. I can't believe you're investing in Tesla. I want my money out. You want to be able to, as any good hedge fund does, respond and go, you're so right. In fact, we were worried that something just like this could happen. So we have $50 million in shorts that we've actually leveraged up 2-to-1. So we basically protected the entire portfolio with shorts. Don't worry, we're good. We're shorting the snot out of Tesla. And you might think we were losing money today, but oh no. You should see the tendies we just baked on them Tesla shorts. They're so good. At the same time though, while hedge funds are playing keep the clients in the volatile time, the rest of the market has what? Less buyers of stocks like Tesla or higher multiple stocks because the hedgies aren't taking new money to buy shares, they're taking new money to short the shares, which is bad. But then when you take new money to short shares, you're actually creating more selling pressure. So you're removing buyers and you're shorting. It's literally like a double whammy of what the hedge funds are doing because they're worried that maybe earnings are gonna miss. You know, your hedge fund weenie babies gotta be prepared for maybe a miss because they don't want to lose a bunch of clients. They can't diamond hand because their clients are gonna paper hand them. It's kind of what's happening. So that right there could be a very, very big reason we are in this sort of doldrum in many sectors in the stock market. And to me, I actually like hearing that because if these companies crush it with their earnings over the next year, ideally 3 quarters, I've got a longer run mindset for my stocks, obviously, in general, 10 years plus, but realistically, I'm not expecting to see some of the highs that we've seen for at least 3 quarters. It's just what I'm building in. I'm thinking like maybe it'd be a Christmas gift. We'll see. That's just an expectation that I have, that we'll see new highs coming towards, September, October, and beyond. So we're going to be going through a little bit of a ride here. But it's going to take a while to squeeze these hedgies out again and make them close their shorts. And it's going to take a lot of validation to prove that we should be at the valuations that we are. Because hedgies are really short-term thinkers. Weenie babies. Remember that, okay? They're really emotional about the short term. So, number one, this is a big thing, okay? If hedgies are doing this, folks, hedgies got lots of money. Speaking of lots of money, the NFT that's available for sale to buy the dip song, which you could see by going to metkevin.com, it's rarible.com/realmeetkevin. That does expire tomorrow, so check that out yet if you haven't seen it yet. My proceeds will be going to charity. But anyway, the second thing that we've got going on is the deleveraging. But it's being accelerated. Remember in previous videos that we've talked about this deleveraging and this great deleveraging possibly coming? We've been talking about how we think it's going to take probably until September or October for us to get margin levels back down to maybe August levels of 2020, which was closer to like $650 billion of margin, and we're over $820 billion as a country right now. Well, it's probably going to take until August, September for us to pay down that margin level. But that deleveraging, this sort of, oh my gosh, we're getting a little high on margin, I think this deleveraging push is kind of getting accelerated by things like the Archegos drama. The Archegos rehypothecation scheme that went on, where basically the dude was able to say, yeah, you could take my phone as collateral. Sure, Citibank, take this as collateral. Hey, Credit Suisse, you want to use my phone as collateral? Cool. Yo, Morgan Stanley, you want to use my phone as collateral? And all of a sudden, everybody's looking at the phone as collateral, and all of a sudden, when the phone falls and breaks, hope I didn't actually break it there. No, I didn't. Then all of a sudden the bank's like, what? You pledged the same phone to everyone, the same money to everyone? All of a sudden it's like, yo, we need less leverage. This is bad. Well, that same kind of deleveraging, I think, is echoing throughout institutions, and it's removing buyer pressure or buying excitement, I should say, from institutions. And it's leading to, again, softer prices, which is reiterating why retail might also want to sort of deleverage on their margin positions. That's what I've been doing. Today, I updated, and usually I don't update this every day because it can be toxic, but I did another pay down today of my margin. And unfortunately, the market fell good chunk today. Some of my big high conviction names got smacked today, specifically Tesla and some others. But anyway, that happens. So I am now, instead of at 21.9% leverage, even though I paid down money, I'm at 22.8. Oh, come on, man. I'm trying. Just let me touch under 20%, please. I'm on my way. But anyway, so now you've got hedgies shorting. So remember, they're removing buyer pressure, shorting. Then you've got institutions maybe not buying, deleveraging because of this Archegos crap and just high margin levels in general. Then on top of that, we still have fears that what if the Fed is wrong and we end up seeing hyperinflation, which in the long term, inflation can help stocks. But in that short term, which is really what the weenie babies care about, in the short term, stocks get wrecked in inflation, especially in high inflation periods at times. In the long term, we'll end up balancing out. But in the short term, it's bad, especially for high multiple stocks. So you got a lot of reason to see red in the stock market right now, especially in the high multiple stocks, which is exactly what you're seeing. And when I look at this as a basket, I go, it's not my picks that are doing bad. It's the entire sector of high multiple stuff that's doing bad. It's all of it that's doing bad. And all that is a clear sign that something's happening in the market. What that something is, we just determined. We just figured out, in my opinion, what that is. Now, I do want to give a few potential catalysts here and provide a little bit more information. So first, Goldman gave a few stocks that, and this is Goldman Sachs, so take it for what it's worth. But this weekend in Barron's, Goldman gave a list of stocks that they believe are undervalued. They said Goldman's laggard list is surprisingly varied. I'm just going to read these off because you might find them interesting. This was a good piece, okay? Read it. Stocks that could pop on earnings reports. Okay. I agree with some of these. Activision Blizzard, I believe that. Some of these I don't know, like Air Products and Chemicals, CF Industries, Charter Communications. I mean, obviously I know Charter, but anyway, Edison International. Enphase made it on the list. I totally agree with that one because I'm heavy on Enphase. And I just, like the last 2 months, I've been like, what? Really? This is such a profitable company. Why is Enphase tied up in this? Everest, RE Group, Fiserv, that's the old school payment processor. Global Payments, Intercontinental Exchange, Leggett & Platt, McKesson, TE Connectivity, and T-Mobile. That's the laggard list. We do also have, so watch out for those. We do also have big earnings coming up. IBM smashed earnings today, which is really good for tech, like really good for tech. United flopped today, which kind of is no surprise, but is a potential harbinger like of doom, like of bad things to come, like a warning sign, like a prophet of bad things to come, for recovery stocks. Because think about it, United's like the first recovery stock here to report, and I mean they didn't do well. Their earnings were not pretty. They had to paint this narrative of don't worry, we might have less flyers than we did in 2019 by like a lot, like 42%, and maybe half of our flights are pretty much empty. But don't worry. Our margins are getting better, even though we're making 20% less money per ticket than we used to. Don't worry. It's bad, okay? It's bad. So those are things to keep in mind when you're in recovery stocks as well. Tomorrow, Netflix and Adobe report, then Chipotle on Wednesday, American Airlines on Thursday, along with multiple others. Baker Hughes on Wednesday, Lam Research, NASDAQ, Verizon on Wednesday, Bank of America tomorrow, Boeing tomorrow, Moody's, U.S. Bancorp, Public Services Enterprise Group. Oh, we got a lot. Abbott Labs tomorrow, CSX. Oh my gosh. I watched the movie The Game yesterday, and I almost wanted to read that as CSR. And then I'm like, wait, are they real? Movie The Game, okay. That was a head trip. Oh my gosh. If you have not seen that yet, watch that tonight. Oh my gosh. Rent it on Amazon. It's like $3.99. Hashtag not sponsored. That was good. But what is sponsored, by the way, are my amazing programs linked down below that'll help you build wealth for the long term. Whether that's finding wedge deals in the real estate market, which, by the way, I personally just found another wedge deal over $100,000 below market value. Check that out if you check out that program if you have not yet. But also consider bundling. Use that coupon code down below. I do plan on having an expiration coming out for that code again, mostly because people keep emailing me telling me, Kevin, for the amount of value you put in these courses, you've way undervalued these. Other people are charging way more for their courses. So I do raise the price over time when there are expirations. But anyway, check out those programs down below. Friday, we have American Express, Honeywell International, Kimberly-Clark, and Schlumberger. We also get manufacturing purchasers index, and we get some Census Bureau report of sales for single-family homes in March, which will be really important for the real estate market, just to get our fingers sort of on the pulse of the real estate market. Yeah, so we do have some catalysts coming up, some data sets. I don't think as much data as we got loaded up with last week, but certainly some catalysts coming up. And hopefully this gives us a little bit of insight into some of the madness that's just happening in the stock market right now. It certainly helps me to stay up to date with all of this because it makes me feel a lot more willing to be a diamond hander. Because if you just think it's just your stocks getting burned and you don't see the correlation between why certain stocks are burning, oh yeah, then it hurts. Then it hurts. So you've really got to understand what's happening to feel less paper handy. So anyway, I've not sold anything. Appreciate y'all being here. Thank you very much for watching. Consider subscribing. Check out those programs down below. And folks, see you in the next video.